Benny, we're looking for bad numbers. We got bad numbers. They were worse, I suppose, than we thought. But give me your take on what you saw in April.
Well, no big surprise. We expected a bad number. We got even a worse number. But you know what? Nobody can predict this kind of numbers. It's totally crazy. The decline is something that we expected. And you know what? The next month will be a very strong number, rebounding, but the level of activity will be much, much slower. So there is no point in analyzing which sector was more or less. All of them were down. All provinces were down. This is a month that we will not see again in many, many years, I hope. And then the recovery is starting. So two points here. One is that the recovery will not compensate for all the decline for sure. Second, that's something that we have to think about, is also when you start recovering, it's not just the number of operations starting activity again, it's also their productivity. Because of social distancing, you will not be able to go back to normal. Even if the demand is there, you have to follow those guidelines, which means that the productivity level will go down dramatically. So even if you have people working, opening up, the ability to produce will be much less than what it used to be.
And just wanted to say, Benjamin, we were waiting for word. 1 o'clock is when the province of Ontario makes some of its announcements today. It is adding new regions to the list of those that will move to so-called phase 2, so businesses can reopen in these regions. There had been some wondering about whether Toronto would be on that list. It is not. There are other regions, Durham region, Halton, Hamilton Public Health Services, York region. So there are those outside of the Toronto area. But we're still seeing this big disconnect in different parts of the country, Benjamin. And, as we look to the U.S. as well with that second wave, how do you factor in the kind of stuttering start? And when you say, we won't see a full pullback from the declines we've seen, you're saying you don't see a V shape, it won't snap back. How do you price in this kind of concern about the stuttering nature of how we're reopening?
Yes, it's very, very difficult. If you look at the US is opening up much faster than any other country, especially Canada. They're basically taking a gamble. They're saying, let's open up, see what happens if there is a second wave. And we know that we see in some states the beginning of a second wave, but you don't see a second wave in the US as a whole. And that's a gamble, because if they are winning this gamble, their recovery will be stronger than Europe and definitely Canada. But also this W business also will be worse in the US if there is a second wave. So they're really taking a risk here. And maybe it's a calculated risk, but that's exactly what we are doing. Canada is taking a different approach. Clearly, Ontario is taking a different approach. There is so much pressure to open up Toronto. And it's not happening, not yet. So they are taking their time. They would like to avoid the second wave in Toronto. Time will tell who is right, but clearly there is a higher risk at the approach taken by the Americans.
You're also looking at a couple of details inside on corporate balance sheets in Canada, and that is the raising of cash while they draw down other assets. So just I think we can actually show this graphically, Benny, but walk me through what you're looking at here.
Yes, remember dead money? In 2012, yes. Mark Carney, back then the governor of the Bank of Canada, was accusing corporate Canada that they are not spending their cash. If you look at this chart, if in 2012 it was dead money, today it's totally dead because it has risen dramatically since then. And the point that I'm making, Amanda, this is not dead money. This money is alive and well. Over the past 2 decades, it has been buying its way to the credit market. Many, providers of credit said, listen, I don't care about inventories. I don't care about receivables. Show me the cash. So the cash level went up. Receivables, inventories went down, as you can see. So it was basically replacing it. Now, the point that I'm making here is that now with the new environment, post-COVID, we might see a situation in which the market will start rewarding inventories. All of a sudden, we were totally exposed to the supply chain space, realizing that we need some inventories. So for the first time in 20 years, we might see a situation in which cash will go down, inventories will go up, because the market will start rewarding a situation in which you sacrifice short-term profit for long-term resiliency. That's what I'm seeing.
That's so interesting. And so you would expect then to see an inversion of those two charts, the cash levels to come down. And when you say rewarded, would you expect to see that to show up in sort of investor interest, that investors will start looking for those businesses that have, when you talk about resiliency, you're talking supply chain inventory resiliency, which is kind of a new concept.
Absolutely, because until now, it was the less inventory you have, the better, because the margins are benefiting. Mm-hmm. I'm saying, you know what, the market will start looking at the situation differently because we were totally exposed during this crisis. We are still exposed to the supply chain space, and we know that it's going to change. Clearly, deglobalization is happening, not to the same extent that the people are talking about, because you cannot reverse globalization, but it's happening, and you will have a situation in which 20% of American imports from China is actually some sort of essential goods that will be coming back. It's happening, and many companies will say, you know what, we are willing to sacrifice this short-term profit to get this resiliency, and the market will say, be my guest, this is okay with us.
When would you expect to see that start showing up? I mean, going back to that, these are long-term trends, right? I mean, we've seen falling inventories and accounts receivables going back to, you've got the chart going back to 1988. Should we begin to see this over a very long term, or would you expect to see a spike in inventories in the next, say, 6 months?
I think it will be faster than expected. I think that we have to go through this semi-recovery that we are seeing, you know, the virus business, we don't know yet. So over the next 6 months, we will not see much of a change. But beyond that, I think that within the next 2 to 3 years, you will see a significant difference in the inventory level and the relationship between cash and inventories. I think that companies are talking about it. The trend already, by the way, started before the crisis. And again, this crisis will accelerate that trend. We need a higher level of inventories. I think that markets are starting to realize it. Clearly, CEOs are starting to realize it. I don't know if you will see it over the next 6 months, but over the next 2 to 3 years, I'm sure you will see this trend.
Benjamin Tal, always great to have you with us. Appreciate it. That is Benny Tal, Deputy Chief Economist at CIBC.